Risk always comes with a certain level of rewards. You may get a 100% increase in your capital by investing in a certain crypto coin, but at the same time you may lose 100%. But wait, we'll not let that happen to you. And taking a 100% risk for a 100% gain isn't the best trade though. For example, in the case of most people, it will make them lose their hard-earned money which took them years to earn. And guess what? In this video, we're going to come up with the right diversification formula, which will help you get the same level of returns as you would have got through maybe a relatively riskier trade. Okay, so the common or say the best time of making the best return is when the weather is in favor of investors, meaning the investing market is in the mode of growth. Wait, let me elaborate on this concept. If you are interested in the crypto market, and you will know the concept of Bitcoin dominance. You will never see the Bitcoin rising and at the same time all other currencies going damp. Instead, they all follow the same sort of growth, and some coins outperform the market due to some growth-oriented reasons, similar to crypto, which is the most volatile and needed to be quoted to understand the concept of diversification. Let's now understand the stock market. Considering your work for a publishing house and want to invest in stock, you will lose money if you only acquire shares in your own company and it goes bankrupt. You will want to diversify and buy shares in many of your company's competitors because you are familiar with the book publishing industry. Some of your company's intrinsic dangers, however, may also exist in other book publishing businesses. If something goes south, your stake in the publishing industry would plummet like anything. In this situation, you failed to see the underlying, irrational risks of each company in which you invested. These kinds of mistakes can be avoided if you consider creating a well-diversified portfolio. Diversification limits the potential highs and lows by averaging the returns of the assets in the portfolio. Diversification among firms, industries, and asset classes provides the best protection against market risks, financial risks, and volatility for the investor. Diversification is what they mean when they say don't put all your eggs in one basket. To yield a better risk-to-reward ratio, we need to invest in assets that don't rise and fall together. One example of this will be financial services companies and companies based in real estate. When the interest rate goes down, we expect low profits for banks. However, real estate industry booms in this scenario. One very famous style of adding these kinds of non-parallel assets is adding stocks as well as bonds to the portfolio. A smart investor should always use a mix of stocks and bonds in his portfolio for effective diversification. Many factors distinguish stocks and bonds along with the risk and return that investors can expect. Stocks and bonds play different roles in an investment strategy because of these variances. Stocks have a limitless potential for gain, but they also have a higher level of volatility. Bonds, on the other hand, are more stable assets that pay out dividends, but have a lower potential for growth. There are benefits of having a mix of stocks and bonds due to their distinct risk and return profiles. It's rarely an either-or situation. A smart investor decides upon the 75-25 or 50-50 or 25-75 ratio between stocks and bonds kept in the portfolio depending upon the risk appetite. Let's say that an investor has chosen a 50-50 split between stocks and bonds. Now, when the stocks go up, he will sell the stocks and buy into bonds, maintaining a 50-50 split. And when the stocks fall, he will buy more stocks to keep his split 50-50. That way, he will automatically end up buying low and selling high. Assume that you are investing in the S&P 500 in January of 2007. Your total loss will be over 16% by the end of 2009. The overall loss would be reduced to 12.6% if you invested 90% of your money in the S&P 500 and 10% in bonds. Your loss would be around 5.7% if you just had 30% invested in bonds, whereas a 50-50 portfolio would earn 1.2%. Why should you put money into bonds? Well, because bonds can help you control risk. But when it comes to popularity, bond portfolios typically trail behind stock portfolios. Bonds don't seem to attract the same attention as their far more exciting stock-based counterparts, although they play an important role in overall asset allocation. They're frequently built as an afterthought and remain idle for years, producing revenue. Bond portfolios might provide income, net profit, and diversification, and can be as risky or safe as the architect chooses. They are a great deal to trade when you are building a bigger investing portfolio. Bonds don't have the scale of returns which can be expected through, let's say, surging stock or the crypto market. But on the other hand, they are risk-free, and you'll only get to lose money if the government goes bankrupt. Okay, so how should you think of bonds? Are they investments just to control the risk level? But that's not completely correct. From 2001 until 2013, VBMFX bonds performed better for 12 consecutive years, and from that time, stocks have been seen to outperform the market. And now, when can we expect bonds to perform better than stocks again? Bonds have a deep relationship with interest rates, and interest rates tell the story of how you can get more out of bonds, even better than stocks. In a high interest rate scenario, bonds are expected to yield better results than stocks, and if the interest rates go low, you can expect the stocks to perform better. Don't worry, we'll be coming up with a detailed video upon analysis of different bonds and what to look in them while investing. Make sure you're subscribed to enjoy more doses of our videos, and thanks for watching till the end.